Hello and welcome to the Keen Asians classroom. My name is Dr. Hriday, but you can address me as Professor or Your Highness. I'd like to welcome you all to Economics 101, where we break down fundamental economic concepts and explain them to you. We're going to be talking about quite a taxing topic today, so you guys might want to take notes. Today we're going to talk about indirect taxes and their impact on the market for certain goods. In this video, I'll explain to you the concept of indirect taxes, why a government levies indirect taxes, and the impact of taxes on markets with elastic and inelastic demand. Now, an indirect tax is a tax usually levied on sale compared to your direct tax levied on income. This tax is usually collected by an intermediary, and these taxes are usually passed on from the producer to the consumer. The most common example of these taxes are excise duties on goods like alcohol and cigarettes, value-added tax, or the goods and service tax. Some advantages are that they allow the poor to contribute to the economy. As most of them do not pay direct taxes, they are collected in small amounts, which is less obvious to the public, and they are easy to collect. Also, they can be used to discourage consumption of harmful goods. Now, the government collects taxes for two main reasons: to earn some extra tax revenue and to discourage the consumption of demerit goods. It is important that governments, especially of countries like India, where less than 2.5% of the population pay taxes, that governments collect indirect taxes. Indirect taxes account for more than 65% of Indian government tax revenue. Now, whether Indian direct taxes are enough to sustain the economy or not is an issue for another video. The second reason is what we're going to focus on for this video. The government also places taxes on a good to reduce the consumption of goods that are harmful to society. This prevents market failure. Market failure is a situation where markets fail due to not being efficient enough. In the case of demerit goods, these are goods that have negative externalities, which are negative impacts on parties who aren't buyers or sellers. Because they have negative impacts on society as a whole, they are overproduced and overconsumed by society. Whenever a tax is placed on a good, the producer absorbs some of the burden of the tax as an additional cost of production, and some of the burden is transferred to a consumer as an increase in price. This in turn causes demand to contract. Due to an increased cost in production, the amount of supply from the producer's side decreases, which means that the quantity supplied at every price reduces. This means that the supply curve moves to the left, the price goes up, and in turn the demand contracts, allowing the government to reach its objective. Let's take an example. Suppose you have a cigarette which costs 10 rupees with market demand of 50 units, and the government places a tax of 3 rupees per unit sold. Now the producer decides to absorb 1 rupee in the tax himself and transfers the remaining 2 to the consumer as an increase in price, making the new market price 12 rupees. As a result of the change in market price, the demand will then reduce to 40 units. Now let's take a look at who gets how much. The old producer revenue was 500 rupees. The new producer revenue is now 360 rupees, which is basically what the consumer pays minus what the government gets into the quantity demanded and market price. The government revenue from the tax is the tax amount multiplied by the quantity sold, which is 120 rupees. Now let's take a look at elasticity of demand. The elasticity of demand is a measure of how responsive demand is to a change in price. The more elastic the demand is, the larger the proportional change of quantity demanded to a change in price. Now, the more responsive a demand is to the change in price, the lesser a producer would want to change the price. That means the more elastic the demand, the greater the burden would be absorbed by the producer in order to affect demand as little as possible. However, the more inelastic the demand is probably not going to change that much to a change in price. That means that more inelastic the demand, it is beneficial for the producer to transfer as much of the burden as he can to the consumer. If you want me to explain these two diagrams in detail, do let me know in the comment section down below. Anyways, that brings us to the end of this topic. The main issue with indirect taxation on goods like cigarettes is that taxes don't really achieve their objective of reducing production or consumption because demand is most likely to be inelastic for such addictive goods, and the producers can just transfer most of the burden of the tax to the consumer. So Aryan, my question for you and everyone else is indirect taxation a good way for the government to control demand and end market failure for such goods? Or are there other important steps that they need to take and indirect tax is just the way for them to earn extra money? Do let me know what you think in the comment section down below.